What's up, everybody? Nick Powell's publisher of 1851franchise.com. We have many of you watching from all over the world live. So if you are watching live, if you happen to be watching this live, you can use the comment feature on whatever app you're watching this on to ask questions as we continue to dive into today's discussion. As always, Wayne, I want you to kick us off with kind of the state of the union, what's going on with the business, give us the update, and then we'll go to Steve's story.
Thanks, Nick, and welcome, everyone. Great to have so many partners, potential partners on the call with us today. I think we have a record number of people joining, which is fantastic, and here to answer all questions, and really excited to have Steve Fisher with us today, one of our latest partners based in San Jose. So, Nick, want to steal a couple of quick minutes. I think just to start, as we have in the past, with just a bit of a state of the union around what we're seeing in the industry itself, because the industry just continues to become more and more dynamic. What's interesting is I'll share with you a couple of stats. One really interesting stat that just came out. There is now 50%, 50, more vacant office space in the US than there was entering 2020. So if you think about it, in 4 short years, we've gone from record absorption rates to record vacancy rates, 50% more vacant office space from this short 4-year period. We know vacancy rates are at record levels across the US and Canada. 12-month sales volume is down 52% in the US, 29% in Canada, and more space continues to come back to market. 12-month absorption rates, net absorption rates are negative. We saw a negative absorption rate of 63.4 million square feet that came back to market last year. And if you look across the top 60 markets in North America, they have double-digit vacancy rates. So availabilities continue to increase. And we currently have 1.8 billion square feet of available office space in just those 60 markets. So the market has just completely shifted. And experts, as we discussed last year, we're seeing more of this type of movement. And experts are predicting that vacancy rates will only continue to rise throughout 2024 and 2025 for 2 significant reasons. One, we're seeing more leases come up for expiry over these next 2 years. A number of 10-year leases are hitting that level of maturity. They're expiring, and companies are either shifting, they're shrinking their office space needs, or they're shifting to new models. And this is taking place during record employment levels throughout the US and Canada. So when you look at the actual leasing activity that's taking place today across the US and Canada specifically, traditional leases have become, they're very similar parallels to what's taking place today for leasing. It's smaller. So we're seeing leasing activity drop 17 to 25% in terms of square footage. It's most notably linked to built out space and incentives that landlords are required to offer in order to secure leases have drastically increased. We're talking rent abatements, office rent costs, TIs, a real significant capital shift. So while this is happening, you see the world within leasing. Now let's talk office attendance. Now, Castle Systems, for those of you who know the company, Castle Systems tracks anonymous key card data across the 10 big office markets here in the US and provides some guidance. They've been tracking this since the early days of the pandemic. Office attendance has plateaued at about half of what office attendance was in early 2020. So we're now at 53% office attendance versus what it was back prior to the pandemic. But what's interesting about that fact is, if you look pre-pandemic, the amount of space, so the amount of office utilization was roughly anywhere from 50 to 65% of the space that was leased, right? So we're talking about basically a halving of the half of what was being used. So we're really seeing this remarkable structural foundational shift in how we work and how we will continue to work in the future, and how companies are utilizing space. Like, if you think about record levels of employment, therefore you would have traditionally aligned that parallel with needs for space. But yet we have 1.8 billion square feet of available office space in just those top 60 markets. Technology is one of the major drivers. We're seeing 4 key reasons. Technology is enabling people to work ubiquitously, and companies are completely shifting their real estate model. We're seeing this need for the corporate office really start to shift. The days of the single location corporate headquarters are really over. It doesn't mean that office space isn't needed. People need an ability to congregate. They need an ability to come together. They need the ability to socialize. They need the ability to collaborate together, to be productive. But because technology is becoming such an enabler, people are using space in a much more purposeful way, and companies are becoming more geographically distributed. Commuting is driving a major shift, both the cost and the impact on the environment. And then you have this combination of those 4 factors that are really leading companies to become more borderless in how they recruit and hire team members. So prior to the pandemic, many companies would hire from the market that they operated in. So for example, Steve, who amongst his portfolio of buildings has a great building in San Jose, a company who headquartered out of San Jose would more than likely hire a large percentage of their workforce within the San Jose market. That's shifted, where yes, companies are still hiring within the local market they serve, but they're also expanding based on the requirements of the job. And because technology has become such an enabler, they're able to be able to hire out of city, out of state or province, sometimes out of country. So we're seeing this complete shift. Now, while that's taking place, it's a story of distress. Right? We have $2 trillion worth of lease maturities coming up over the next couple of years, really by 2027. While that's happening, it's a story of opportunity. Because what we're seeing at IWG and in Flexible Workspace is the demand for our Regus locations, our Spaces locations, our HQ, our Signature locations is up 40% versus pre-pandemic. And in 2019, we saw 1 million inquiries come into our organization. Those are people, companies that were calling, looking for our space. That number has grown to 1.4 million annualized. So while we're seeing this distress and this shift, fundamental shift away from traditional commercial leasing, we're seeing a significant increase in demand for flexibility. So it's a brilliant opportunity. Now, while this is happening, we've, as many of you know who've joined, we've been pivoting. In 2022, we introduced the partnership model, where frankly, we realized we're not a real estate company. We are a technology-enabled hospitality organization providing a platform of amazing workspace locations for people, companies, from 90% of the Fortune 500 right through to the freelancers who need great space to access around the world. We launched this program in 2022. In 2022, we signed roughly 500 partnership agreements in our first year. Those were new partners joining who were making an investment in their space that was empty, looking to drive cash flow and ultimately premiums on their space, converting that space to an IWG location. And in 2022, we started with 500 signatures, of which many are opening today. Last year, we doubled that number, close to doubling that number, by signing 867 new Flexible Workspace locations. And this year, based on January and February numbers, we're going to double that number because the demand continues to grow. And frankly, we are looking to continue to grow with great partners who have space available, or we can bring that space onto our platform as a great location to meet the surge in demand that people are looking for, which is greater flexibility in well-designed space. So it's been a really interesting dynamic last couple of years.
Wayne, I appreciate that opening statement. Steve, I want to hear your story. How did you even get involved with IWG? But secondly, everything that Wayne's talking about, I'm curious in the starting position of you having a discussion with the business.
Yeah.
Are you aware of this in the process, and how do you get introduced into the brand?
Well, it's I mean, everything Wayne has said speaks to exactly how we got involved with IWG. We were introduced to the brand a few years ago prior to the MCA model that they started in 22. We looked at one of our buildings as an opportunity it was a kind of a JV cost sharing agreement. I can't remember, Wayne, what the process was or what that was called at that time.
Yeah. It was a shared profit or revenue share agreement.
Right. Well, we have a building that's very similar to what is happening in the marketplace. It's a beautiful building, downtown San Jose, that's had its troubles since COVID. It's a 35,000 foot building, 4-story, has a basement, had a restaurant that we lost during COVID. We had great tenancy on the top 2 floors, creative type uses, an architect firm, a marketing firm, paying great rent for the building. But we saw that as those leases were going to burn off, that we were in a little bit of pressure to figure out how we were going to drive some activity to our building for the vacant space that we had. And we finished off the second floor, about 6,500 feet, at a 2-story atrium, and it had this beautiful space, ideal for a design or creative type person. We built out the restrooms and just left it open office. It sat there for the longest time post-COVID. And so it was probably a little over a year ago, Joe Bakay, one of their sales team members, reached out to me and explained the new model. And luckily, we were in a situation with our partnership that I was able to go to my partners in-house. We can do decisions here. It's easy. We're not part of a big institution or have to go back to a CMBS loan to get it approved or anything like that. So we were able to look at the model, see how we can drive activity that would protect the property long-term. And I've bought into the model of the idea that co-working is the way things are going. So it took a while, but we got together the agreement. We worked on designs. We initially had started to do an open floor plan model for the building of ended up being about 8,000 feet of space. And we went to a more private. We put extra money into it because we believe in it. And it just opened. We had our grand opening in the first part of this month. And we're about 25% occupied, hoping once we get that up to about 50%, we have one more floor that we just vacated that will move into about 8,000 feet.
Steve, out of curiosity, because obviously a big portion of our audience are those that are either at the entry point of discovery or they're in discussions and they're trying to get over whatever hurdle they're trying to get over. Were there any hurdles that you had to come over or overcome in the sales process that you had to get comfortable with, or was it a straight line to yes?
No, it took a little bit of negotiation. It was a fairly simple process to understand what the management agreement is. That we are truly, I think if Wayne could probably explain it, it's almost like the hotel industry in the sense that we are the owner, they're the operator, we're using IWG technology, they're driving the tenancy, they're managing the day-to-day process. So, not knowing how it was going to completely work, it took a little while to understand that, and we looked at a couple different locations. This building was unique because it was a small ownership structure, and we had a private regional bank that we have a great relationship with. But we have another building that we looked at that we would look at doing the same model, that there is some potential issues around the way you finance that lease versus a corporate lease. And I know Wayne is, I've spoke with him about the ideas of they're working on ways to be able to put some sort of mechanism in place to allow that to happen. I don't know if Wayne, you want to maybe say something about that.
No, it's a great point, Steve, because it's one of the realities at times that a partner, building owner, investor can have is, this is a different model. Like to Steve's point, this is very similar to a hotel model, right? In which a partner, a building owner is making the capital investment to build the product, and we're operating that center, driving the revenues of which ultimately, after management fees, go directly into the pocket of the building owner. But it's different to a bank at times because it's not a secure credit facility, like, for example, a lease is, right? So this is it's interesting. It's traditional and proven in industries, in many membership-driven industries like hotels, like fitness, like restaurants, and it's a very similar construct, but it feels different to a lender because it's taking office space and hospitalizing office space. So what we've been working on, and Steve and I were discussing this the other day, is coming up with an evaluation booklet, an evaluation mechanism where a lender can take a look at the evaluation and be able to assess how they can value a management partnership agreement, that type of management model, and provide some security for a development loan, for example, to be able to invest in the TIs or invest in the building, to be able to secure that for a partner. And I think that piece, I think, will be a good unlock for partners who either want to or need to secure that development loan from a tier one vendor.
Yeah.
So we're working on an evaluation mechanism right now, essentially a finance book that, by the way, it both looks at the building itself and then provides a statement of the model. So that way a bank can understand how the model works and how net proceeds grow. And then also provide great examples of our current business, because we've been operating for 35 years. What's interesting is what we're building in the financial model is exactly what we've been doing for the last 35 years. The only difference is, in the past, prior to the pandemic, for the most part, we would take a conventional lease, and then we would share in the TI investment and the capital investment to build. And then in turn, we would drive our cash flow, right? We would cover our costs, and then and then drive cash flow returns. And then as a center matures, as it does over 10 years, then it starts driving premiums. And the business can be premium intensive. We've had some countries that would drive a 2 to 3x return on rent, which is a great return for any of us, right? And the business continues to grow as it matures. So part of that financing package, we want to be able to provide to a bank, frankly, to help provide education and understanding around how this concept works. So we're going to provide our examples from a balance sheet perspective, and as well, good indicative modeling to help demonstrate the impact and the benefit on the building to help secure the loan.
Steve, I'm curious on just your viewpoint on things. We're hitting 4 years since COVID, and obviously COVID was a shakeup to the way that the commercial real estate would work, or that lenders or landlords could handle these spaces. What's your mood like today versus, say, 12 months ago? Like, how has this shift happened? And obviously with IWG, we're starting to see what a potential solution or a solution can be to vacant spaces. But what's your mood like? How are you feeling about things currently as opposed to maybe the last few years?
I mean, it's we know co-working can't pick up all the space, so it's going to be tough for some time on the office sector, depending on what type of products. Older generation products going to have a tough time. I would say the mood is definitely better than it was 12 months ago, but it's just a very slow progress on that side of the sector. My main business of what we do, Valley Oak Partners, we were formed after the Great Recession to do land entitlements for housing. So we are we have a great entitlement team. We self-funded our company from 2008 on until about 2 years ago, and we did about 30 projects. We did about 2,500 homes. We entitled about 1.5 million feet of office that we got out of and sold the entitlements, one piece to Boston Properties. And so that part of the business was great. About 2 years ago, we formed a fund, And it's surprising with what's happening in the office market that this fund was a $60 million fund that we're doing an optioning land. We have control of about $300 million worth of land and entitlement in the Bay Area. We're entitling about 1,800 homes right now. And that area of the market, outside of the multifamily side, which is having some financing issues, is very strong. It's like you have other aspects that are doing better than others. Retail, surprisingly, is doing okay right now. So it's what's happening in office is a huge shock, and all the reasons why Wayne had mentioned, the 4 reasons of what's happening right now is truly taking place. And there's a lot of uncertainty how deep it's going to go in these pullbacks. So you have to get creative on doing things. So that's kind of what we're trying to do on the spaces that we have in downtown San Jose. Like a lot of cities had a lot of issues with crime, homelessness, and that's changing. It's getting a little bit better. There are some people coming back to work, and it's getting a little cleaned up, which is nice to see.
Wayne, traditional diversification of a portfolio in a commercial portfolio would be I buy more buildings. It's almost like there's diversification happening within the portfolio by now opening up this opportunity. Is that the take that other partners are looking at this, that they're looking at it? How can I diversify within the 4 walls that I already have?
It's exactly the case. We've had instances, we've seen partners, which is understandable, face a situation that we're now 4 years in, that 4 years ago may have been thinking, okay, this change is going to happen. We're going to go back to what was taking place prior to 2020. People will come back to work, right? It will happen. We'll see pickup in our office, et cetera. We're 4 years in. So a lot of people have been waiting on the sidelines for things to dissipate, the things to materialize back to what it was. The reality, though, is we've gone through a structural shift. This is not like an economic recession like 2008 and then a bounce back. And if you think about the bounce back in commercial real estate after 2008, we had one of the longest bull runs in commercial real estate history from 2010 to 2019. I can remember in 2019 being at an event, and there was this conversation taking place around this pending recession. Something was going to disrupt the market. It was just so strong. And of course, none of us could predict 2020. And what we've now seen is a structural movement. This is not a bounce back. This is a structural shift. And it's not a bad thing. It's a good thing for people. Companies will shift and they'll shift how they approach their business. They're looking at their balance sheet differently than ever before. They're starting to look at what's a capital liability and how can we flex on this. And it's a great thing for the environment as well. So what we're seeing is this complete structural movement, and diversification is looking differently now, Nick. Like to your point, we're seeing a few things, which one is we're seeing the introduction of flex space into more and more buildings to a greater degree than ever before, because it's providing diversification in the asset, right? So many building owners are looking at 15 to 30% of their building, and they're taking that 15 and 30% and they're saying, how can I make that more vibrant? How can I make it attractive? And most critically, how can I monetize the space to start driving some immediate cash flow? Because right now it's sitting empty, and we're paying for taxes, and we're paying for utilities, and we're paying all of our operating costs. So how do I shore up that hole? And then how do I possibly incubate for the future? Right? Because this movement of flexible workspace and flexible working is continuing to grow, right? So how can I, as a building owner, really start to take advantage of this and use it as an amenity in my building? Very similar to how buildings used to operate with other amenities, whether it was the cafe, the gym, et cetera. We're looking at flexible workspace as an amenity. And as opposed to just building it themselves, hoping to operate, now many are saying, look, we need to partner with an operator. And it's no different than a hotel, right? You want to work with a best-in-class operator who has access to the clients. Because what we see from clients is clients are not taking the time nor do they have the time to investigate across who all the operators are in flexible workspace. They're looking to deal with a trusted group and be able to provide all the services in the space that their team members need, regardless of the city they operate in. So diversification is shifting in a portfolio now where they're taking 10, 15, 20, 30% of that portfolio or that individual building, and they're diversifying that towards flexible workspace. And I believe we're going to get to a point where you look across, it's all about network, right? This is a platform-based business. And I believe that most assets, most buildings will and should have that percentage of space allocated for a flexible working operator, because the need is there from clients who have established traditional leases are asking their landlords, hey, do you have any flex space that we can leverage for all the various reasons that we see people come in? So diversification is shifting. And I believe that most buildings will have an allocation towards flexible workspace today and in the future.
Steve, just for clarification's sake, can you talk about your space? What does it look like? Square footage? How is build out? How is that process?
The building is a 4-story, 35,000 foot historical building, brick and timber building with a basement that had a restaurant, like I said, before COVID. We're hoping to make that a speakeasy or jazz club someday I think the IWG guys would like that. The space is laid out to where they're essentially 8,000 foot floors, except this second floor has an atrium. And so it's really divided. It's beautiful space. And we felt that if we did the first floor and the second floor, we have San Jose Symphony in the back of the first floor for the time being. If they stay, that's great. If not, we would probably convert that to more co-working space and then just go through the building. For our portfolio, this is a building we've targeted that over the long haul, we think it could be a great location to just keep adding more co-working space in this submarket of downtown San Jose. So different than just taking 15 to 30%, this building, I think in the long term, if we're successful, we set it up in a way that when you enter the front of the building, the left-hand side is like a reception area for IWG. They could manage the whole building from that location. So we've kind of set the building up in a way already to do that long term.
I'm going to start throwing up questions as they come in, but Jeff said, how many offices did you get for the 8,000 square feet?
I think we have, off the top of my head, about 89 desks. And we have one area on the bottom, 1,000 feet on the right side of the first floor is pure kind of daily co-working space. And I think we have 19 desks in there. It's got a little coffee bar. We have the reception area. And then upstairs, we probably have, off the top of my head, probably 15 privates. And they vary. We worked with the Bay Area sales team to come up with a plan of mixing up the privates. We have them down. We have one unit that's a single desk up to spaces that have a private with like 6 or 7 desks. We built a couple phone rooms. Somebody can go in and have some privacy and have a phone room, and then a conference room that tends to be used most of the time for local people coming in and using it on a daily rate.
Another question, Wayne, what pickup in per square foot rents are you seeing for IWG style spaces today versus traditional leases?
It's a good question. So I think a few things we're seeing right now, depending on the market, we're normally seeing as the center matures. So I'll give everybody some background as to how it normally works. So we traditionally model out the 10-year model for a partner for them to be able to see how a center matures. Because this business is not unlike any other business, right? It starts, it grows. What's interesting, it starts to hit maturity anywhere from, let's call it month 18 to sometimes like month 32, month 36. And we normally see a return on net capital, usually that year 3, year 4 mark. What the first thing we want to immediately do is demonstrate to a partner that time period where they start to see that cash flow return. That piece for us, we feel, is really important because we want our partners to become to be able to be in that cash flow positive situation based on their investment. And then from there, as the center matures, we're seeing anywhere from a 2x to a 4x return on market-based rent. And I say market-based rent, but it's interesting. It's really difficult today to predict what market-based rent is, right? It's such a moving factor. And so we normally see anywhere from a 2x to a 4x return on that market-based rent overall. Now, what's interesting, though, Nick, is many of us will have partners who they'll start, we launch, and then there's that expectation that month one, quarter one, there's a proceeds check. We're working towards it, right? So we aim for a 20 to 30% opening occupancy, which Steve mentioned. He's right in that line. We model out a 10% opening occupancy because we have to build the sales, the marketing element as we go, right? So there's a number of steps we take around portals and around SEM and SEO and digital prospecting to start driving interest in the site. So we normally model out at 10%, and then we hit a maturity usually around 2.5 to 3 years at 85%. Now I say 85% being mature, mainly because 85% can sometimes feel like 100% in this world of flexible workspace, because when you're at an 85% capacity level at the floor, it's usually you don't have 3 offices left together. You've got an office in one corner, you got an office in another corner, you got an office down in another corner. So we hit maturity around 85%, and we really start hitting maturity around revenue, and then frankly net proceeds to a partner at that year 3 mark. And then you start seeing the premiums. Our retention rates on average are 70%. So as a client signs, normally for 1 to 3 years, 70% of those clients continue on. These locations become their work homes. It's interesting. It's flexible because of all the reasons why they do not need to approach a traditional lease, but it becomes their place of business, their residence. And they maintain a 70% retention rate. So what happens is you have your residential revenue that just continues to grow and mature. And then we drive anywhere from 105 lines of non-residential revenue, but there's really about 15 really strong non-residential lines. And those are pure profit that come in. So the business really matures from that year 3, year 4 moment. And then the premiums really hit beyond that. So long answer to the question, but I wanted to walk through a bit of that journey. But we usually see a 2x to a 4x return on rents.
Go ahead. Yeah.
I was going to say, I think, Wayne, it's interesting because when we looked at the model in the sense of this hotel concept that we're in a partnership with you, and since we built it out, we're paying some sort of fee for you to operate and you're using your technology. It was really the rent was one thing, but it was all the other line items that as it matures, and it'd be interesting to explain to people how much of that over what the base rent is. It's quite a bit. And especially as you mature and you end up having people come in for mail service every month and they don't go anywhere, or they just use the address and they're paying a fee for it, or they're stopping by to use the meeting rooms. It's interesting, the model, once you get it matured, that it really gets going.
You're exactly right, Steve. It's the model, if you can kind of picture my visualization here, it starts like this for those first few years. And then it really ramps up like a hockey stick, as a true Canadian. And the reason why is, to Steve's point, what's interesting about operating a flexible workspace location, because we're underpinned by such a large technology infrastructure, and because we have such a broad scale of centralized services, the team in the center who operate the location is traditionally on average 2 people. They can operate a 20,000 square foot flexible workspace location with 2 people. And they're focused on the client experience every single minute of the day. because everything else that's required to administer, from the billing to invoicing to vendor management to managing all the amenities to the mail elements, all of those elements are centralized. The phones are centralized to our centralized help desk. When somebody calls in, they're calling into a centralized group, and we treat it like it's the local center in San Jose. Right? So the team is able to be a high-end concierge to the clients in the center. So you have your fixed costs are there. Your depreciated capital is in place from what you invested in to build. And by the way, that could cost anywhere from a couple $100,000 to, for example, Steve had made an investment of if you don't mind me mentioning, Steve,
right,
but 1.5 million. And good reason why, because he cellularized the space. He built offices. The highest demand product that we have today is still the 1 and 2 person office. Because there's sometimes this misnomer around co-working where it's this big open concept space, butcher block tables, everybody working with their Beats headsets. The reality is 70% of a well-designed co-working facility is private offices with a great, efficient lounge that has soft seating, great reception area, great kitchen facilities that people can congregate in and be able to work collaboratively and then escape to an office if they need to work privately. It's all about an ecosystem. Right. So, but what's interesting is fixed costs is your depreciated capital. And then the center operating costs, although they're variable, are relatively fixed because the occupancy increases, your staffing costs don't go up. And then you start seeing your virtual office revenues, which is 99% profit, that accelerates. Because as people sign up for a virtual office, they keep the virtual offices. It's both their company image, and then most critically, it drives their Google search analytics, right? So you have meeting rooms, you have virtual office, you have day office, you have catering, you have all these different line of co-working memberships, all these different line items of revenue sources, of which 30% of a center revenue is driven from non-residential revenues, which is best in class in the industry. Our competitors drive 6%, we drive 30%. So you have all of those revenue lines growing while your variable operating expenses are relatively fixed, because most of your variable operating expenses is staffing, of which in the end is usually 1.5 to 2 people, right? So you really see the premiums, to Steve's point, and the profit accelerate as that center matures, because it stabilizes as an occupancy while your costs are stable, but your revenue grows.
All right, let me keep cranking through some of these questions. Some of these are going to be very, very easy. Like this one, David just said, how should he reach out if he wants to talk with someone about the partnership opportunity? What would you say there, Wayne? Go through the website?
I would say go through the website, or if you're jotting something down, reach out to me directly and I'll put you in front of the right person. It's wayne.berger, BERGER, at IWG plc.com. I know that's not that easy, but or ping me on LinkedIn. You can find me. We have 100 partnership growth directors throughout North America who reside in virtually every state, including the great state of Alaska and Hawaii, of which we're opening up one of our newest partnership locations here shortly. They will be there happily to help ensure you have the consulting guidance you need. We'll provide a financial model. We'll help you lay out your construction cost estimation. What we care about is you can make a great decision for your building. So reach out and we'll get you in contact with the right person, or head to our website and enter in your quick details, 4 fields, and we'll get you in front of the right person.
Okay, great. David said, seems like tenant improvements would be so much higher than normal, and then adding all the services, furniture, systems, and staff to run the space would be very costly. Either of you have comments on that?
I do, actually. Let me real quick is just to look at our opportunity is we had plans to do a build out of an open office build out. It was probably going to be about $700,000 to do with furniture, everything in, and we decided to do the private offices. The contract bid came in at about $800,000 of hard cost. We ended up having a couple $100,000 in change orders. Being a historical building, we had to do some upgrades, some different things that were not really IWG driven. It was more the building driven. So, and then soft costs and all our setup, that included our starter kit with IWG, which included our phones, our lock system, all the operating to start everything with them, fees with them. And then furniture, we put in about 300,000. So when we spent about $1,450,000, $1,500,000, that included everything, soup to nuts. And then I just want to touch back on the revenue side real quick. Is when I look at how we look at our deal is, yes, we're looking for that third year, fourth year, but we were looking at it, what would happen if we were to go out to the marketplace if we found a tenant? And we didn't think we were going to find a tenant for a long time. We probably still wouldn't. We'd be sitting vacant for a long time. Is if we had a lease put in place, we'd probably have most likely a year of free rent. We'd have to put the same TIs out. It would be a big investment for one tenant. And we put a big bet on one tenant for that deal. Versus with the IWG model, where we stand today, we're 23% occupied. We are covering our overhead in the build space right now. The next probably 10% to 12% of occupancy will cover our triple nets for the space, and then we're in the money. And it's for us, it's going to happen a lot faster than it would be if we were to do a traditional lease in today's market, if we were to find that tenant. So we had to kind of make a decision to drive that to happen today.
Steve, was that your expectation going into this?
In the sense of occupancy, or?
Yeah, and pacing to break even?
To start off, yeah. I mean, of course, I would love to be at 50 or 60% occupied, but we knew it was going to take some time to get there. And that's, we were going to originally, we were going to look at building both floors at the same time, the second and third floor. We decided to, once we get to about 50, 60% occupied is when we'll kick off the third floor.
Wayne, very simple. How does IWG get paid?
It's really simple. We collect a management fee. Right? So there is a nominal signing fee that covers all the costs that goes into getting the center set up, getting on our systems, our platforms, brokerage portals, the pre-work that goes into getting a center launched. And we collect a 16% management fee to operate the center. And that includes everything from the billing system, the account system, all the management, all the technology elements, all the infrastructure pieces, the portal elements that connect to 8 million clients around the world, of which, as I mentioned before, we have a very large percentage of those as Fortune 500 clients who are looking for space routinely as they are shifting away from traditional leases to more of a flexible model. So it's a 16% management fee. There's a recuperation of the center operating costs, of course. So we pay the center operating costs and we recoup those through the proceeds. And when I say that, you think it's payroll, some bad debt, any rechargeable operating costs. Beyond that, every dollar of proceeds goes to the building owner. That's it. We have a management fee. Every other dollar goes to the building owner. We want to make sure, for us, we're an operator, right? We're going to drive a best-in-class operations. We have a large infrastructure behind us. We have a large sales and marketing organization. We're going to fill the center. We want to make sure that the proceeds go to the building owner. So beyond the management fee and the recuperation of the center operating costs, which are a paid cost, every dollar goes to the partner.
Both of you can answer this. Steve, you can do it specific to yours, and then Wayne in general. What site-specific amenities do you offer in your spaces?
Wayne, you probably have better sense of every different spaces. Mine's fairly traditional. We have a co-working space. We have a little cafe area, which has coffee for everyone, meeting spaces. And like I mentioned, we put in phone booths for privacy. But I know Wayne has much, I'm sure quite a few different spaces and different amenities.
We operate in North America, roughly 1,800 locations, of which 1,300 are open and another 500 under construction. So it runs the gamut. And by the way, the size runs from 4,000 square feet. We have a beautiful location in Goose Island, Chicago, great little neighborhood, 4,000 square feet, fits the neighborhood perfectly, right through to 100,000 square foot spaces location. So the amenities will range based on the size, but it is interesting. I'll say that it's one of these elements in co-working or flexible workspace. What you really need in a space is you need about 6 to 7 different work environments. So to Steve's point, a great location is designed with your reception area because you have the team there to support the client's needs and the guests of the clients. You have let's call it a small cafe kitchen area. And I say small, but it could be decent size. But it's that element to provide all the kitchen services, the cafe facilities that clients need. There'll be a collection of meeting rooms. If it's a 10,000 square foot center, 2 to 3 meeting rooms, perfect. If you can, a couple of booths, because people love the ability to shift in and out of their private space and congregate together. So a couple of booths, some soft seating. To Steve's point, a couple of phone booths, because as your co-working members come in, they need a way to escape to go on a Zoom call, to be able to make a phone call, connect on a Teams meeting. So a couple of phone booths. And then beyond that, it's a range of office sizes, from your single person office to offices to accommodate 2 people, 3 to 4 people, 5 to 8 people, and a couple of team rooms. So it really comes down to that collection. Now, as the spaces expand, we operate everything from fully functioning cafes, terraces, patios, large event spaces. We have a great spaces location that has a podcast studio, complete event spaces that drive event income as well, gyms. So that it really expands. And what we're seeing is we're seeing a lot of interest start to expand for the management model beyond just office space. We're looking at light industrial. We're looking at wet dry lab space. We're looking at student university type space. So the management model kind of fits within it because it's really about managing platform of space versus just office space. But to answer the question, Vince, most of our spaces really operate within that model of walking into a really nice club space that is desirable. You've got your reception space, you've got your kitchen, cafe amenities, some meeting rooms, phone booths, a couple of booths, and then your collection of office space.
Okay, next question. Could you go over a little on median rentals as a percentage of revenue and daily rentals as a percentage of revenue?
Yeah, it's a good question. Steve, do you want me to jump on this one? So I'm interested to give you a couple of details. So I know I mentioned earlier on 30% of the total revenues in a center are what we call non-residential revenues. And specifically around meeting room rentals and daily rentals, to give you an idea, we're actually the world's largest provider of meeting rooms. Meeting rooms make up roughly anywhere from 10 to 15% of our overall revenue. It's quite significant. And the meeting rooms are interesting because we operate the meeting rooms. You can rent them directly if you go onto our collection of IWG websites, regis.com, spaces.com. A client can go on and rent right away, or they can work with their team members inside or call IWG direct. So they can rent directly through our website. And then we also have a separate meeting room website called Meeting Go. And then we also have our meeting rooms available on other platforms. So the access to the meeting rooms expands just beyond the internal clients. So as Steve mentioned earlier on, he has his meeting room. That meeting room will be rented both by internal clients who reside at the center, have their offices at the center, and it will also be available to the public, and the public will rent them as well. So it represents roughly anywhere from 10 to 15% of the overall revenue. And then the daily rentals, and I'll call daily rentals both membership as well as what we call day offices. And those day offices are usually our virtual office clients who want to use an office for 1 day a week. But in the meantime, they want to maintain the virtual office experience. That's usually representative of about another 10%. And then the virtual office element is quite sizable. That usually makes up about 15 to 20% overall.
Comments are rolling in, so we'll go as rapid fire as we can. We'll get to as many of these as we can. So next question, can you share some operating statements for your partners' projects? I assume this is in the sales process. Is that something that's feasible?
Yeah, I guess the only question comes down to what an operating statement they're looking for. What we can share is a few things. But we couldn't share reporting statements from our partners' projects because it's confidential information to our partners. But what we will provide is a few things. One, we can provide indicative models directly related to your building, and plug in all the traditional elements around what your base rent is, gross rent is, your triple net, lay out your operating expenses, lay out a construction cost model as to what it would cost to convert the space. And by the way, that it can run anywhere. We've converted space that was traditionally built out. We've gone into space that was now vacant. It would have been traditionally media design offices, law firms, brokerage houses, and the space is actually built out really well for a Regis or an HQ. We've been able to take that space and convert it to a fully functioning flexible workspace for sometimes $90,000, $150,000, $250,000. We're talking at times $20 to $30 a square foot. So it can be that entry level based on what the current construct is, and then also what you want to do with it. Like, I really applauded Steve for the investment they've made, because they have a lot of open space. And open space, you can transition into some really good co-working, but unique offices drive so much of the monetization. So they made a good decision. But back to the question, sorry, we can provide some really great modeling. We can also provide actual case studies, operating statements of our centers as well, because we've been doing this for 35 years. And in many locations, we've continued on in the building for 35 years. Why? Because it's very profitable. This business matures, it continues to grow. So we provide case studies and operating details around our current centers. And then we can also provide some additional modeling as well. So, and what we'd also do is certainly provide some really good references of partners like Steve, who's taken the step, be able to speak with them directly to get their thoughts on what's worked, where we can improve, because there's always opportunity, and what we can do better.
Okay. Steve, what was your cost per square foot to develop your space?
It was probably hard cost all in, including all the extra improvements I mentioned to upgrade the building, because it was a historical building, was in the tune of about $120 a foot. And then we had the furniture add and some of the soft costs. The one thing that we did and we chose to do, which I do recommend, is I had spoke to some other operators, and there was a process to, getting through the process to get your space from start to finish and hit a timeline. Some of them were delayed in the sense of running through city process or different things through some of the design process and getting finished to get it, because you really want to get it open, get the center going. So we use a gentleman by the name of Alex Ingram and Associates, who is kind of later in his career and looking to retire soon and wants to work on some smaller projects. And he assisted us with this on construction management and project management of the site. And it really, we targeted back in March when we were going to reach for our permit meetings in July, is when we were pulling with the city of San Jose. We picked dates in March for basically to be completed in November, and we hit the dates. And it was a process, and it was a lot of work working with the different teams at IWG and him, but he kept things in line and kept us abreast of everything. So I would recommend maybe spending a little bit of extra money to have a project manager on your side to assist you with that. Okay. On the ownership
side. Is the model intended for second generation space that has been vacated only, or can it also be meant for repositioned property that needs to do a full build out to accommodate IWG requirements?
Yeah, absolutely. We've been seeing over the last year more and more future developments. It's really interesting. More and more future developments that are being built ground up, in which building owners and developers are looking to institute flexible workspace into that multi-use development. So it really, the simple answer is yes on both. We've seen a lot of second generation, frankly, because if you take a look at the amount of sublease space that's out there, this is a brilliant option. But traditionally, we've always built ground up in a repositioned property. And we're seeing a large number of partnerships start to move forward here on new development, repositioned properties that require full build out.
One other, I want the second one. Hold on. Joe said, can it also work in blue collar, lower rent areas?
Oh, so this is a really good question. And Steve mentioned something earlier, which was perfect when we were talking about just the state of the industry. As we're seeing the shift, there's definitely a flight to quality, right? And there is going to be a significant gap in what we call B class, C class buildings. This works really well. And the reason why is because we have a diversified brand strategy. So if you design something nice, productive, aspirational, doesn't need to be overly expensive, we will attract the clients. Now, we have a brand called HQ, which has been really well integrated into, let's say, that it mentioned that the blue collar type of building, and Regis as well, in which it's really about proximity. People want to have access to a workplace close to where they live, where their clients are, or where they need to be. And our HQ product, for example, is 25% less from a cost perspective per square foot than Regis, and probably 35% less than the Spaces. So we have brands that match really well into that type of building. And frankly, building aside, if you build something that's really well done, it will attract the client base. And proximity plays a key role. So this is a really good fit.
With our
level of distrust. So sorry, go ahead, Nick.
Yeah. With our last few minutes, I'm going to pick a few questions here that we can answer. They're loading in here, so we'll make sure that we get responses beyond this. But here's one. Does the 16% management fee provide on-site staff?
No, so it does not. So 16% doesn't include the on-site staff. That essentially is the management of the costs, all the overhead that isn't required in the center. Obviously, invoicing, billing, platform, marketing, sales elements, all those pieces are in the 16%. But the center operating costs cover the staff on site.
And that's what I mentioned real quick, was where we stand at 23%. After the 16% management fee, our management fees that we paid IWG, the remaining net to us covers that on-site operation. So it's now going forward, it's going to get into our triple nets and then net profit to us.
Okay. Is it possible to design a layout that will ultimately fit both traditional office tenant, not open shared space, and light medical tenant to be able to provide a product that can be desirable for a larger market?
Simple answer is yes. It really just comes down to the usage utilization permitting in the center, or sorry, in the building, which is usually a requirement. And then from there, you can easily design it for sure. Not an issue.
And then we'll make this one an easy one. How long is the agreement?
10-year agreement. So it's a 10-year agreement. We do have an option around some termination clauses that are usually performance-based, based on revenue or occupancy. So that's definitely negotiable. We're happy to work within that. We normally model these out for a 10-year agreement.
Okay, great. Well, there's a ton more questions in here. For anybody that's been watching, you can go to the 1851 page, which is 1851franchise.com/international workplace group. And questions that we've been asked on previous webinars are addressed on there, as well as all the previous discussions that we've had with other partners, should you want to find more information there. But Steve, thank you so much for joining us and presenting your viewpoint on things. Obviously, people can find you online. And Wayne, excellent job again. Thank you for everybody for participating. Tons and tons of communications in our chat room. Again, we'll be sure to get all these chats over to the team to get addressed. So, Steve and Wayne, thanks for doing this. It was another lively discussion. Appreciate it.
Thanks, Nick.
Thanks, Nick. Thanks, Steve.
Of course, for Steve and Wayne, I'm Nick. This is another episode of IWG, Getting to Know the Business. So, thanks everybody. Thanks for participating. Take care.